Welcome to the ITSM Practice Podcast.
Welcome to the ITSM Practice Podcast. I'm Luigi Ferri, and today we explore a subject that rarely excites founders, but often decides whether a fintech startup survives its own success. Governance, risk and compliance, GRC. If you want to operate, scale, or be acquired in the European Union, GRC is not decoration. It is the structure that turns ambition into credibility. It is what transforms good ideas into companies that investors can trust and regulators can respect. Many founders postpone GRC, convinced that it slows innovation. Yet the longer you wait, the higher the cost. When governance arrives late, it comes as damage control. In the European market, credibility is the true currency. Investors, partners, and regulators expect discipline from the beginning. A fintech that runs without clear responsibilities, risk oversight, or compliance visibility may grow fast, but it grows on sand. Establishing GRC early is a foundation. It creates the space for innovation to happen safely, without fear that tomorrow's success will expose yesterday's shortcuts. Europe has built one of the world's most demanding regulatory ecosystems: PSD2 for payments, GDPR for data, DORA for operational resilience, MiCA for digital assets, AML and CTF directives for integrity. These are not obstacles, they are signals of maturity. In other parts of the world, controls tend to follow growth. In Europe, control must precede it. Understanding this cultural difference is essential. European regulators assume that if you manage money or data, you already behave like a financial institution. The burden of proof is on you. The question every founder should ask is simple. Are we building a startup or a financial company in startup clothes? Because in Europe, the second description is usually closer to the truth. Governance is not a slogan. It is a structure that defines who decides, who reviews, and who is accountable. Even a small startup can design a sound governance model, appoint an independent advisor who challenges decisions, keep a clear separation between those who execute and those who oversee, create minimal committees for risk, audit, and compliance. Even if meetings happen in a shared workspace instead of a formal boardroom. Good governance gives freedom to decision-making. It signals that the company is serious, not improvised. And it prevents the concentration of power that so often turns founders into single point of failure. Every startup lives in uncertainty. The difference between resilience and collapse is the ability to recognize risk before it materializes. Start by identifying where exposure hides: operations, finance, regulation, technology, market strategy. Then define what level of risk you can tolerate. This becomes your risk appetite, the line between courage and recklessness. A founder who understands that boundary can make bold choices with clarity. Risk management is not fear, it is awareness. It turns reaction into prevention and improvisation into judgment. Compliance has an undeserved reputation as a brake. In fintech, it can be an accelerator. Meeting regulatory expectations earlier reduces friction with banks, partners, investors. It also prevents that awkward moment when growth attracts attention and attention reveals weak foundations. A dedicated compliance officer, even part-time at the beginning, can create the backbone, internal policies, staff training, transparent reporting, dialogue with regulators. In the European ecosystem, this is not an administrative task, but a competitive advantage. Compliance is the language through which innovation becomes trustworthy. Many startups design frameworks that never reach daily life. The bridge between ideas and execution is project management. Treat GRC implementation as a real project, with objectives, timelines, responsibilities, and follow-ups. Use the same agile discipline you apply to product development. Plan, test, improve. Project management ensures that GRC is not a document on a drive, but a living process that shapes how work is done. If governance is the head and risk is the heart, project management is the muscles that keeps both in motion. A GRC structure must grow with the company. In the early stage, founders may wear several hats. The chief executive officer as a compliance officer, CTO as a risk manager, and that's acceptable as long as decisions are documented and oversight remains independent. As funding rounds increase, the structure should mature. Formally assign compliance and risk roles, establish committees, engage independent audits, and integrate technology for monitoring and reporting. Every step you take in this direction reduces surprises when due diligence arrives, because due diligence always arrives, whether from investors, acquirers, or regulators. The most common GRC mistakes come from speed without awareness, policies written once and never reviewed, risk registers buried in spreadsheets, founders convinced that compliance can wait until the next round. The gravest mistake is subtler, creating a product that quietly carries risk inside it. A payment feature without AML logic. A data integration that breaches privacy by design. These are not technical bugs, they are governance failures disguised as innovation. No investor wants to discover those risks after signing the term sheet. Fintech lives on trust, not just technology. Governance, risk, and compliance are not decorations. They are the scaffolding that lets ideas grow safely. Start small, start early, and let your controls evolve with your product. Avoid the illusion that you can retrofit discipline later. It never works. And if you want to go deeper into structuring a GRC model that fits your business stage, you can reach out. I'll gladly share practical methods that work in the European context. Above all, build a product that earns confidence instead of importing risk into the future. I'm Luigi Ferri, and this was the ITSM Practice Podcast. Arrivederci.